So now, what we're going to do is we're going to look at below the threshold. And so in this and a couple more, I'm going to show you how that is calculated. And whenever we look at how it's calculated, I'm not going to keep it real complex. I believe in understanding the concept before we complicate it. And the other thing is, thank God that we have computers, but we have to understand whether the computer is right. So we're looking at above and below the threshold. So here's a diagram, and the question is, do you qualify for QBI? First thing is, in this flow chart, it says, is this business a C Corp? No, because if it was yes, stop. C Corp, we're done with this presentation. But our answer now is no. So, step one, no. Does the owner's taxable income exceed the threshold? Well, now I'm going to introduce the threshold. Now, this is the original thresholds. For an individual, it's 157.5. Now it's at 160. It's indexed every year. It'll keep changing. Your computer software knows that. For a married couple, it's 315,000. So are we in excess of the threshold? So the question here, are we above the threshold? And throughout my presentations, you're going to see an arrow up and an arrow down. And through all these presentations, an arrow up will always refer to above the threshold, an arrow down below the threshold. So in this case, the answer is no. We are below the threshold. Being below the threshold, then we have a test. So in that test right here, is 20% of the owner's taxable income greater than 20% of the QBI? So the threshold is what? Based on taxable income. At this point in time, I'm going to try to do some. One of the presentations I was doing, I kind of had this. I got to this point, and I looked out there, and I had this like deer in the headlight look, and I thought I got to do something different. So here's what I did. Except it wasn't my grandson's chair. It was actually a live, real chair that was up on the stage. But what I want to do is I want to set this right here. Now, what's going to happen if I go back to the presentation? It says, does the owner's taxable income exceed the threshold? Well, how do we get to the threshold? Taxable income. So I've been giving you some steps on how to get, is it a qualified business? What's qualified income? Now we're switching over. We've looked at that business. Now we're in effect right now. So let's summarize here. What do we have here? We're a flow-through entity. We're not a C Corp. Now we're looking to say, what is our taxable income? We're looking at the 1040. So what happens is I'm on the 1040. It says, does the owner's taxable income? Here's number one in calculation. Remember I said in this presentation we're going to talk about calculating the deduction. We've defined it in another group or another series of presentation. Now we're going to define it. Well, what's taxable income? If let's say for example, I'm going to say this side of the chair is the 1040. This side of the chair is QBI, Qualified Business Income Calculation. So right now, we looked at the entity. It's a qualified trade or business. Now what we're going to do is we're going to look at taxable income. So rule number one in calculation is you calculate the 1040 as if the QBI does not exist. To get to taxable income, you got to go down, the front page, and you're going to get the deductions and the adjustments. In the old day, we turned the return over on the back page, and we came to taxable income. At the point in time we come with taxable income, what is it? Here's the point. Until we get to taxable income, QBI does not exist. That's the first rule. You got to calculate the taxable income on this side of the chair. So the 1040 is over here because this becomes important through the rest of this presentation. So at that point in time, we take 20% of taxable income as the limit. How do we do that? Is the following. We take taxable income and we go over on this side of the chair to the QBI was worksheets. Now it's to the 8995 or 8995A. And we take taxable income over here, and if it's above the or if it's below the threshold, then what does it say? We get 20% of taxable income or 20% of our qualified business income, whichever is less. So that's all this worksheet does. So we look, here's our qualified business income. Notice where it first appears. It appears on this worksheet. Notice that qualified business income is never on the 1040. It never gets over there. Let me do something. Let me just back up for a second. In this series, I keep talking about knowing the law and knowing the old law. For a moment, think about AMT, alternative minimum tax. We've had around for decades. What did you do? How'd you calculate? How's your computer? You or your calculator calculate AMT. You calculate the 1040 down to taxable income. And then you go over to the AMT schedule and calculate AMT income. See, over here on Schedule A, medical expenses has a different threshold number than over here on medical. Okay? We've got 10% over here. Most years we have 7.5% over here. If I look at over here on the 1040 side and I'm taking depreciation, depreciation has this life in this method over here, but when I get over here for AMT, we have a separate depreciation schedule that affects AMT income. When we get done calculating the AMT, we take one number off of this form and bring it over here to one line on the 1040. We've been doing that for years. It's the exact same concept. What we're going to do, now I'm switching. AMT, we got the taxable income, went over to AMT to the form. We calculate AMT income and the tax on it, and then it came over here, one number. QBI works the exact same way. You've already done this process, except this case it's a deduction. So what we're going to do is get, again, rule one, you get down to taxable income. We're going to take taxable income and go over here on this side of the chair to the QBI forms, the 8995. And because we're below the threshold here on our slide, what we're going to do is we're going to say what's 20% of our taxable income, and we're going to look and take 20% of QBI. Whichever is less is going to become our QBI deduction. We're going to take that QBI deduction, that number, and leave here. And we're going to go over here on the 1040 where it says QBI, taxable income before QBI. We're going to put that deduction on there. We're going to subtract it off of taxable income, and guess what? We complete the 1040 as though QBI never existed. That's one of the big takeaways in doing these presentations. I can't say it enough. Can't say it enough. We calculate our tax return until we get to taxable income. Then we stop. And then we go over here and go, well, there's that Schedule C. There's that K1. We're going to pick those numbers up. And then what happens is when we get done, we're going to take one number, whichever is less, 20% of QBI or 20% of taxable income, and take that one number over here and complete the 1040. The only thing on the 1040 related to QBI is one number that comes from over there on that side of the chair. That then is this right here. The deduction is limited to 20% of taxable income. Let's do a basic example, and that's what this next slide is. This is example one, below the threshold. Let's test our flow chart here. So the first thing is this a C Corp? Schedule C? No. So we got a Schedule C with income of 100,000. Now I'm not going to worry about the self-employment deduction. Let's keep it kind of straightforward. You know, this is in the class. so we can make our own rules. But we got a Schedule C and of 100,000. We've got a W-2 of 34,000. So here's my theory. I said we're on this side of the chair, but I'm going to take this chair, this side of the chair, and I'm going to put it on the screen. So here's what we're going to do. Draw a box. That box is what? It's a 1040. So let's calculate our 1040. Front page, we've got Schedule C, 100,000, plus W-2 is what? 134. Married filing joint, let's do a standard deduction of 24. Again, that's indexed from year to year, but for calculation purposes, I take 24 off 134. What do I have? I have now 110 is my taxable income. That's my 1040. Now let's take this and go over here. We're going to go on this side to do the Form 8995. So when I look, what is 20% of my QBI? Well, what is my qualified business income? From the given, it's 100,000. So let's take 20% of 100,000. What is that? So here what we're doing is that we're doing the Form 8995. So what's 20%? What is 20% of 100,000? It's going to be 20,000. So 20,000. We're over here on this form, on this side of the chair. Then what's 20% of our taxable income? 22. What did our flow chart we just have say? Let's go back to it. It says it's right here. It is 20% of the owner's taxable income or 20% of QBI, whichever is less. We're limited to 20%. So, which is less? The 20% QBI. So what we're going to do is come on this side of the chair, and as we come over, we're going to take this 20,000, and we're going to take it back up to the 1040. We're going to take 20 off, and now we have a $90,000. Now we're ready to go on and complete the rest of our return. Now, when we get more complex and actually do the 1040, we're going to have the self-employment adjustment. There's some other adjustments. But please, for right now, understand the concept. What I just did on the prior slide was flowcharted it. What I'm doing on this side is showing that the 1040 is on this side of the chair, the Form 8995 is on this side of the chair. What did we do? We calculated the 110,000 here. We took it over here and took 20% of it, compared it to 20% of our 100,000, and took whichever's less. And then what we did is that less was 20% of our 100, or 20,000. We pulled it back over here on the 1040 and continued doing the return as we've always done it. And I think this is important because whenever I do the presentation on real estate rentals, what happens is people go, well, do I put it on a different schedule? No, you don't do the 1040 any different than you've always done it. The deduction is not determined on the 1040. The deduction is over here. Or another way of saying it, the 8995 is there to determine the deduction based on qualified income that made it to this form. So that's kind of part of the concept, the understanding. Now, when we get into losses, I did a YouTube on the losses and whether or not they get to the taxable income. But for this presentation, you now have the concept and a very straightforward of how QBI works. Just to follow up on that, here is the worksheet that was in 2018. And the reason why I put this in here is that then I show you the form, the 8995, to show you the form that is for 2019 return.